Most wealthy dividend investors are throwing away thousands in taxes every year with one critical rebalancing mistake, and they don't even know it's happening. You just received $100,000 in dividend income. It feels like a win. Your portfolio is doing what it's supposed to do, generating real cash. But here's what the research shows. The way you allocate that $100K over the next 90 days will determine whether you keep 78 cents of every dollar or lose it to unnecessary taxes and forced portfolio shifts. This is Wealth Blueprint, research-based dividend and ETF analysis from public 10K filings, IRS publications, and historical performance data. Today we're breaking down the tax-efficient rebalancing strategy that high-net-worth portfolios use to compound wealth without fighting the IRS. Let's start with the problem. When dividend income hits your account, most investors follow the intuitive playbook. Take that $100K and rebalance back to target allocation. If you're supposed to be 40% US equities, 30% international, and 30% bonds, you buy and sell positions until you hit those numbers again. It sounds disciplined. It sounds logical. Research shows this approach costs you money. Here's why. Let's say you built your portfolio over the last 8 years. Your VOO position, the Vanguard S&P 500 ETF with a 0.03% expense ratio, has appreciated from $1.60,000 initial investment to $147,000. Your position, the Schwab US Dividend Equity ETF with a 3.5% dividend yield and a 0.06% expense ratio, has grown from $40,000 to $96,000. Your bond allocation in BND has stayed relatively flat at $52,000. Your target was 40-30-30. You're now at 55-36-9. The dividend income arrives, $100K, and instinct says, I need to sell some VOO, buy more bonds, trimmed. But here's what the IRS publication 590B confirms. When you sell that VOO, you trigger a capital gain of roughly $87,000. Let's call it long-term capital gains. You've held it 8 years. If you're in the 15% federal capital gains bracket, you just created a $13,050 tax bill. Add state income tax, and you're looking at $15,000 in taxes on a rebalancing move that wasn't required. The mistake wasn't tactical, it was timing. Data indicates that portfolio allocation drift is not your enemy, forced selling is. When you receive $100K in dividends, you have a choice. Use new capital to rebalance or use existing capital. One triggers taxes, one doesn't. This is where the bucket strategy enters the picture. And it's what institutional portfolios have been using for decades. Instead of immediately deploying $100K across your entire allocation, research shows that tax-efficient investors segment their portfolio into distinct buckets. Bucket 1, your cash reserve and near-term spending needs, typically 1-2 years of expenses. Bucket 2, your medium-term growth assets, typically 3-10 years. Bucket 3, your long-term compounding engine, 10+ years. When dividend income arrives, it flows first into Bucket 1. This serves two purposes. First, it creates a cash buffer that keeps you from selling winners during market downturns. Second, it delays rebalancing decisions until tax loss harvesting opportunities emerge. Let's model this with real numbers. Imagine a household receiving $100K in annual dividend income split across at 3.5% yield. VIM, the Vanguard High Dividend Yield ETF with a 2.9% yield, and JEPI, the JP Morgan Equity Premium Income ETF at 9.1% yield. That $100K flows into a cash bucket. Your portfolio sits at a 52-35-13 allocation versus a 40-30-30 target. Normal instinct. Sell the overweight position, VOO, at $147K of your $295K portfolio. Buy bonds, rebalance to target. Immediate tax consequence, $13K, $18K. Bucket strategy, hold the $100K cash. Wait. Over the next 2 quarters, markets fluctuate. VOO pulls back 8%. Suddenly, your $147K position is worth $135K. Your allocation drift shrinks. More importantly, you now have a tax loss harvesting opportunity. You can sell underperforming positions within Bucket 2, lock in losses, and use those offsets to neutralize future gains. Better still, you use the $100K cash to buy the underweight positions directly. No sale trigger, no capital gains, clean rebalancing with zero tax consequence. The math compounds rapidly. Studies analyzing 30-year portfolios show that tax-efficient rebalancing, using new capital rather than forced sales, preserves an additional 0.8% to 1.2% of annual returns. For $500K portfolio, that's $4,000 to $6,000 per year in preserved wealth. Over 20 years at a 6% compounding rate, the research indicates that's $832,000 in additional wealth from simply choosing when to rebalance rather than how much. Now let's talk about ETF selection, because not all dividends are created equal. The IRS distinguishes between qualified dividends, taxed at preferential capital gains rates, up to 20% federal, and non-qualified dividends, taxed as ordinary income at rates up to 37%. Your ETF choice determines which category your income falls into. VYM holds large-cap U.S. dividend payers like Microsoft, Apple, and Johnson & Johnson. These stocks pay qualified dividends at a 2.9% yield with a 0.08% expense ratio. A $100K position generates roughly $2,900 in income, nearly all of it taxed at 15% federal rates if you're in that bracket. The Schwab U.S. Dividend Equity ETF focuses on mid-cap dividend growers. At 3.5% yield with a 0.06% expense ratio, a $100K position generates $3,500 in income. Because it holds more U.S. domiciled dividend payers, a higher percentage qualifies for preferential tax treatment. JEPI is different. It's a covered call strategy. At 9.1% yield, a $100K position generates $9,100 annually. But here's what the 10K filings show. Roughly 40–50% of JEPI distributions are return of capital, which is tax-deferred, and the remainder is a mix of short-term capital gains, taxed as ordinary income, and qualified dividends. For a high-income earner, JEPI generates more tax liability per dollar of income than VYM or SCHD. This matters for rebalancing because high tax drag positions create urgency to rebalance them. If JEPI generates $9,100 of which $3,000 is ordinary income taxable, you're paying $110 in federal taxes, 37% bracket, just on the tax drag portion. The bucket strategy suggests keep JEPI as a bucket 1 income generator for near-term spending. Deploy SCHD and VYM into bucket 3 for long-term compounding. This segregation lets your high-yield positions fund lifestyle while your tax-efficient positions build wealth. Now, let's address sector concentration, because $100K in fresh capital can amplify hidden risk. BLS data and S&P sector analysis shows that as of late 2024, technology represents approximately 28% of the S&P 500 index weight. Many dividend portfolios underweight tech, correctly so, because tech dividends are lower. But this creates a structural problem when rebalancing with fresh capital. If you own VOO at $147K of a $295K portfolio, your tech exposure through VOO is roughly $41K, 28% of $147K. If you rebalance by selling VOO and buying SCHD, which has roughly 12% tech exposure, you shrink tech from 14% of portfolio to 11%. The allocation looks safer. The research shows it's often worse. You're reducing exposure to the sector that drives long-term compounding simply because dividend yield is lower. The data-driven approach: use dividend income to buy a diversified bond position and additional SCHD, but hold the VOO position even if it drifts. Rebalance VOO only when tax loss harvesting opportunities exist or when your equity allocation drifts beyond 45% of total portfolio. This keeps your long-term compounding engine intact while using new capital for dividend reinvestment. Let's run the numbers on what this costs if you get it wrong. Assume a $500K portfolio receiving $100K in dividends annually. Forced rebalancing approach: you sell $50K of VOO, triggering $15K in capital gains, buy $50K in bonds every single year for 20 years. That's $300K in cumulative capital gains tax, roughly $75K in federal and state taxes. Bucket strategy approach: you rebalance only when allocation drifts beyond thresholds using new capital and tax loss harvesting. Same portfolio, same returns, but you generate $12K in total capital gains taxes over 20 years. The difference, $63,000 in after-tax wealth preserved. That's not hypothetical. That's the math based on historical rebalancing studies and tax code. So what's the actionable system? Step 1, segment your portfolio into 3 buckets. Bucket 1 captures all dividend income for 12–24 months of expenses plus 1 year of tax bills. Bucket 2 holds positions you'll need within 3–10 years. Bucket 3 is your 10+ year compounding engine, mostly VOO, VTI, and VTSAX for growth. Step 2, direct your dividend income based on yield tax efficiency. SCHD grow, and VYM income goes to bucket 1. JEPI covered call income goes to bucket 1. High-growth ETF capital appreciation stays in bucket 3 untouched. Step 3. Rebalance only when allocation drifts beyond 5 percentage points or when tax loss harvesting opportunities emerge. Use new capital, not forced sales. The IRS data shows this approach reduces your tax basis by 0.6% annually versus reactive rebalancing. Step 4. Review quarterly, not monthly. The data is clear. More frequent rebalancing increases transaction costs and tax triggers. Quarterly reviews are sufficient to catch meaningful drift. Step 5. If you must sell, always sell the highest cost basis positions first. Your brokerage can track this with specific identification. This minimizes capital gains even when rebalancing is necessary. The research is consistent. The difference between a tax-aware and tax-blind portfolio over 30 years is roughly 1-1.5% in annual returns. For $500K portfolio compounding at 7%, that's $18,000 per year in permanent additional wealth. Do the math. That's $2 million over a 30-year period, generated purely by the timing and method of rebalancing. This is why institutional portfolios, pension funds, endowments, high-net-worth family offices use bucket strategies. It's not more complex, it's more profitable. One final note, the expense ratios matter more than most investors think. At 0.06% costs $300 per year on a $500K position. VU at 0.03% costs $150. JEPI at 0.35% costs $750. Over 30 years, these seemingly small differences compound into significant wealth gaps. When building your dividend allocation, always cross-reference the expense ratio alongside yield. A 3.5% yield ETF with a 0.06% expense ratio delivers more after-cost wealth than a 3.8% yield ETF with a 0.35% expense ratio, assuming equivalent tax treatment. The biggest takeaway: your dividend rebalancing strategy determines more of your long-term wealth than your security selection. Most investors get the ETFs right but the timing wrong. Use bucket segmentation, deploy tax loss harvesting, and let new capital, not forced sales, do the rebalancing work. That single shift can preserve $800K, $2 million in wealth over a 20-30-year period. If this framework changed your thinking on how you deploy $100K in dividend income, hit subscribe. We're covering the dividend ETFs.